Richard, let me bring you over to my chart. This is a very simple chart. It's probably the most important chart of the year because it's a 10-year Treasury yield. I mean, when it breaks out, is that it for the flattening yield curve, or does it go back down?
So our view is the yield curve is going to steepen from here. And it's going to steepen because we see at the short end of the curve now, the market is fully priced in 3 further interest rate hikes in 2018. We think that's the correct interpretation. We think the Fed's now on a steady path of raising once a quarter, but the market has fully adjusted to that, which means there's limited scope, I think, in the near term for short-term yields to rise. Areas like 2-year paper to us that now looks very attractive in the US. But when we look at longer-term yields, our view is the path is higher. And the path is higher because growth in the US is strong. The path is higher because we're seeing inflation gradually making a comeback. And importantly, we're now seeing a very significant increase in bond supply coming in the US, more focused at the long end of the curve.
When does the curve invert?
I think an inversion of the curve is still several years away, potentially.
Sorry, several, 2, 3?
Well, I think it's going to depend on the development of the economy over time. So at this stage, what I'd say is that we don't see the inversion of the curve, which is going to predict the next recession. We still see that at least 2 years away. I think we have to recognise that with the large fiscal boost that the US has just implemented, there's greater uncertainty around that. So the risk of overheating, I think, has gone up. But what we're seeing now is actually that inflation is rising relatively gradually. The Fed is in no hurry to invert the yield curve. They certainly don't indicate that they're behind the curve. That if you look at the behaviour of the stock market, it doesn't indicate the Fed is behind the curve. So again, our view is over the next few months, we're going to see steepening rather than flattening. And that's an environment in which we think bank stocks, for example, can continue to do well.